These presentations will work a comprehensive bookkeeping problem both within Excel as well as within QuickBooks. Excel having the advantages of being able to see all the components and how all those components fit together to make the end product, that end product, the financial statements. QuickBooks having the advantage of being able to use forms, simple data input, and an automated system in order to convert that simple data input into the end product, the financial statements. We will work each component of the problem in Excel first and then work that same information in QuickBooks. Hello, in this presentation we will record a transaction into our bookkeeping problem in Excel for an advance payment from customers. Keeping in mind how this same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're going to first look at QuickBooks quickly and then go back to Excel and put this same information into Excel. First, we'll look at the home page in QuickBooks. This is the customer home page. And what we're saying here is we have an advanced payment from a customer, meaning we got paid before we delivered the service. And that's going to be a little bit opposite than the typical type of transaction, in which case we get paid at the same point in time, or we actually often do the work before we get paid. There's going to be situations in which we might get paid before we do the work, and that could be, in our case, we might be getting a down deposit on a guitar. If we don't have the guitar in the store, we might collect a deposit and then order the guitar. There's going to be other situations where we could receive payments before we actually do the work, and therefore can't really recognize the revenue at the point in time that we have received the payment. So we're going to record that in QuickBooks with the receive payment icon, just like we would anytime we receive a payment. However, we usually click this icon after we actually entered the invoice, later on receiving the payment in the mail. In this case, as the flowchart is going here to here, we're doing this opposite. We're doing this first, and we'll enter the invoice after we have completed the work. So when we go to the receive payments, we're going to say that this is the customers, Anderson Guitars. We're going to say that we received 250. We have the date and we have the check number. The thing that's going to be different here is that we don't have any related invoice like we typically do when we receive payment. So this will be the information, what will be the journal entry when this happens. When we have the receive payment, typically we debit cash. That means we're going to increase cash. Not the checking account yet. It's going to go into undeposited funds. And then the other side typically decreases the receivable, matching out the invoice, now saying that we have been paid for an invoice entered in the past. We don't have an invoice in this case, and therefore what we're going to end up having in QuickBooks is something odd, and that's going to be a negative receivable for this particular customer, Anderson Guitar. That is not actually proper, because we would expect that we would have a liability related to the service we need to make in the future called unearned revenue. But within QuickBooks, it makes sense to do this because it allows QuickBooks to agree the accounts receivable to the invoice that we're going to make later and put that to the subsidiary ledger. So this is what we're going to do now. We're going to do the same thing in Excel and record it as QuickBooks records it rather than record it in a liability. And we'll track it in the same format and see why it might be useful to set it up that way. When we do adjusting entries, we'll actually have to adjust for this and increase the receivable and record the liability for the unearned revenue. So let's jump over to Excel and see what that would look like. So within Excel, we'll enter this journal entry, and we can ask the first question we typically ask when we enter a journal entry, and that is cash affected? We're going to say yes, but in this case, it's not the checking account. It's going to be the undeposited funds. Remember what's happening is we're getting paid in advance of doing the work. We're getting a deposit from a customer, most likely on a guitar in this case, and we'll apply that out later. So we're getting the deposit before we did the work, which in the case of inventory would mean delivering the guitar. So we are going to increase the undeposited funds. We did receive payment, so we're going to copy undeposited funds. It being an asset, we will do the same thing to it, which is a debit. So we'll scroll down here. We're going to put our new account, and the date is going to be 216, so we'll put 216 here, and we're going to right click and paste 123, that undeposited funds. The amount then will be, the amount we got is 250. We'll then credit something also for that 250, and here's where the tricky piece comes in. If we were to do a book problem and we said that we received an advance payment, we received payment for work that will be done in the future, we would be crediting the unearned revenue account, a liability account. But we're going to follow a QuickBooks lead and try to show why QuickBooks would do this by recording something a little bit unusual, which is going to be a credit to the accounts receivable account. And that's going to result in reducing the accounts receivable, but it's reducing accounts receivable for a particular customer and amount that we had not already input. Usually we have the invoice and then we reduce it. So what we'll see when we look at the subsidiary ledger is that we'll have this credit there that doesn't have anything tying out to it. We have the payment that doesn't tie out to any invoice. That's unusual, that's not really proper, but it does work in that we can then have this information in our subsidiary ledger. So what we're doing in essence is creating a negative receivable rather than what we should be doing, which is creating a liability. But there's a reason for it, so we'll do that, and then if we have to adjust it at the end of the month when we make the financial statements, we will do so with an adjusting entry at that time. So here is the amount we're going to credit accounts receivable, so I'm going to copy that. I'm going to put that at the bottom. We will right click and paste 123. We're also going to go to the Home tab. We're going to go to the alignment group and increase the indenting. So here's the transaction. It looks like any kind of payment we would receive on account. However, it's a payment we received before the invoice, bit unusual. Here's going to be the debit to the undeposited funds. We're going to go ahead and record that. Before we do, we will freeze the panes. Scrolling up to the top, going to cell AJ1. We will then go to the View tab. We're going to go to the Windows group, and we will select Freeze Panes and freeze the panes. Then we're going to scroll back down and we're looking for undeposited funds. So here it is there. It's going to be in the same location on the general ledger. So we're going to scroll to the right, looking for that undeposited funds. I think it's going to be in this column here. I'm guessing this column. Scrolling down, it's going to be in AU24, AU24. We're going to select that equals, and then point to this 250 in C30 and enter, and there we have the 250. I'm going to correct this undeposited funds up top. We actually put that, it's a credit, it's doing the right thing, but it's on the debit side. That's coming from this account here. I'm going to correct that now by just moving it over here. To do that, I'm going to delete this. We're going to be in the credit side in AV23. Select equals and point to that 825, and then everything should be back to where it should. Here's the 250 for the undeposited funds. I'm going to scroll back over to the undeposited funds in the trial balance, and we see it here. There's the 250. Scrolling back down, we're going to do the same for the accounts receivable. There's the accounts receivable. Accounts receivable is there's the second account on the trial balance, therefore the second account on the general ledger. Scrolling back over so we can see them side by side, we're going to go to the debit. In this case, we have a credit of the 250. We're going to scroll up. We want to be in AR8. We're going to have to scroll down a little bit in order to post this. So we're going to select equals, scroll down a little bit in order to post this, and point to that 250 in cell D31 and select enter. So there's going to be the item, brings down the accounts receivable. Scrolling back over, we should find that 965 in the receivable on the trial balance. There it is. Now we've adjusted something to the receivable. We do want to track that by who owes us the money. So we can see more detail about this 965 by looking at the general ledger. However, we only see the information by date there, and we want to see it by who owes us money by customer. So we're going to scroll all the way over to the subsidiary ledger. We're going to enter the same data. However, this time it will be by customer. We're scrolling to the right. I'm just clicking the right arrow until we get to the area we want to be in, to the right in the subsidiary ledger. Here is our subsidiary ledger, and we're looking at Anderson Guitars, who currently doesn't owe us any money. what we're going to do is just record this same credit, 250, here. So we are in CS10. I'm just going to say that that equals and point to that same 250. Enter. And there we have that. We have the 250 there. It's now a credit. It's a negative receivable for this particular customer, Anderson Guitar. Again, that's unusual. That's weird. That's because Anderson Guitar gave us an advance payment. So we actually owe Anderson Guitar something. What do we owe? The guitar or whatever service was promised, and or we owe the money back at the future point. Typically that would be, once again, a liability, but putting it here in the subsidiary ledger allows us then to match up the later on invoice we will have nice and neatly without having to match that up with another account that doesn't have the same subsidiary ledger. So from a practical purpose, does make sense, although from a generally accepted accounting standards purpose, not entirely correct, because we really have a negative asset instead of what we should have, which is a liability. We will correct that if need be when we create the financial statements and make adjusting entries at the end of the month. Scrolling down, we then add up all of our accounts. If we sum all these up, adding all these up, we then have a balance of $965. That then should be the balance also on the trial balance. Let's scroll all the way back. I'm just holding down the left arrow just to check that out. Make sure that that is indeed the case. There's that $965 there, so it looks good. We're then going to unfreeze the panes. I'm going to go to the View tab up top. We're going to Windows Group and Freeze Panes, and then unfreeze the panes. Then we'll go ahead and see what this has done to the financial statements. So I'm going to select the accounts receivable. We did something to that, and I'm just going to point to that on the financials. We also did something to the undeposited funds right there, so I'll select that and point to that on the financial statements. Then we will scroll to the right until we find the financial statements and see what we have here. We've got the accounts receivable has been adjusted. Undeposited funds has been adjusted. Again, that should probably be part of the cash account up here, but we're going to break it out separate so we can see that being tied out. We have the total assets still equaling liabilities and equity. No effect on the income statement because although we got money, we haven't done the work yet and therefore cannot recognize the revenue at this time. We do still have a loss of $246, therefore that loss part of the owner's equity calculation to get the ending owner's equity of $143,929. That amount part of the balance sheet here on the balance sheet. Hello, in this presentation we will record an advance customer payment within QuickBooks Pro 2018. If you've been working along with us, we will be continuing with the Get Great Guitars problem. If you have the backup, you could restore that backup at this point with a file and restore the backup. If not, that is okay. We will be recording an advance payment, a payment that has been received before the invoice or the goods have been shipped, that being a guitar in this case. In order to work this problem, we currently have the home page open. To open the home page, go to Company and Home Page. We also have the Open Items list open. That's under View and Open Window List. Only window open is the home page at this time. Our scenario is here that we have a customer that would like a particular guitar. They've requested to hold that guitar for them. In order to do that, we have requested a deposit on that guitar. So we're going to hold on to this piece of merchandise and therefore give that piece of merchandise in the future. So we're not going to create an invoice because we have not yet sold it. But we have received money, so we have to record the fact that we've received the money. So this is a circumstance in which it's a little bit backwards when we look at our flowchart, meaning typically we have an invoice and then we collect the money, we get the check in the mail. In this case, we got the money before we create the invoice. So what we're going to do is we're going to create that invoice and we're going to create the receipt payment, depositing or recording the fact that we have that $300. In this case, we're getting $300 for the guitar that we will sell in the future. Then, once we sell the guitar, we're going to create the invoice and we have to be able to apply that credit to what has been sold at that point in time. So this is to record a deposit from a customer before the work has been done. In accordance to the revenue recognition principle, we can't record the revenue. Therefore, we cannot create the invoice yet because we have not yet earned the deposit we are receiving. Instead, we're going to record this receive deposit or receive payments, and we'll see what the transaction is and look at the financial statements and what's being recorded and how we would then deal with that in the future. So we're going to go to receive payments. We have received a payment for a customer in order to hold on to a particular guitar. That customer is, if we select the drop down, we could find the customer. It's going to be string music, very bottom. I'm going to start typing it in, and that will give us the item. So we're going to say tab. We're going to receive 300. The date's going to be the 21st, so I'm just going to hit the up arrow or the up plus button to get to the 21st. It's going to be cash. We're going to say cash here, and then we're not going to have a reference number, and that will be it. So once we have this customer payment, we're going to record this note that it's not being applied to any particular invoice. If there were an invoice that String Guitar had out in place, we would have to make sure that we do not apply it to that invoice if it's a deposit on another guitar, an advance payment that we have. The fact that it's not being recorded to another invoice means that when we create an invoice for this customer, it will then be available to apply that credit, this prepayment, to the invoice that is created. What's going to be the transaction when we record this? The fact that it's a customer payment means that it's going to be increasing the payments. You would think cash, but typically QuickBooks is going to put it into that undeposited funds account until we put it into the bank, until we go to the bank and record the deposit side. So it will be increasing undeposited funds. The other side of it, you would think, would be decreasing a particular person's receivable, typically when we have a customer payment. But we don't have any invoice here. What it's going to create then is a negative receivable for string music. That is odd. That's not normal accrual accounting, but it works well within QuickBooks, meaning normal accrual accounting would say we would need a liability. We would need to credit the liability and say that we owe something in the future. That something in this case being the delivery of the guitar. If we don't give that, we should be giving the 300 back. So we owe something in the future. In this case, we're going to have a negative asset. Why? Because that makes it easy for us to track the asset in accordance to the customer, and when we then create the invoice to tie those things out. So let's take a look at what that will look like. We're going to say save and close, and it's going to say we're going to create a credit. We're going to say that is what we want, okay, and look at the reports that we have. We're going to say reports drop down. We're going to go to company and financial. Let's go down to the balance sheet and see what we have in the balance sheet. We're going to change the dates. So we're going to go to customize reports, and the dates will be from 01/01/21. We will be working in the future to 12/31/21. We are working in the future. By changing the date ranges here, although there's only one date here, once we drill down on the data, we won't have to change the data when we look at basically the general ledger or the transaction reports. So we're going to go to the accounts receivable first. Here is the receivable. If we double click on that amount, we see that 300 here. The split, the other accounts going to undeposited. Here's the 300 in the receivable, decrease in the receivable. It's in the receivable, although it's not being applied to any particular invoice, as typically the payments will be. As we can see with some of the payments up top, where we have the 525 here, the payment being related to this invoice, the 430 here being related to this 430.50 here. Here we've got the 300 payment not related to any 300 invoice, but decreased in the receivable. If we close this back out, and we then go to the undeposited funds, that's going to be the cash account, undeposited funds. Double clicking on that, that should be the other side of the transaction. Scrolling down, we see that 300 there. Double clicking on that, we see our customer payment. Closing this back out, we'll take a look at one more place where this will be, the customer report, the reports by customer. Go into reports up top, go into customer and receivables, scrolling down to customer balance detail. And going all the way to the bottom where we have the string music, we see this 300, and it's a negative receivable. Again, that shouldn't be the case. We shouldn't have a negative receivable. However, the negative receivable helps us when we tie out the invoice to the particular customer. So we don't have to be jumping from the liability accounts to the receivable account. If we keep it all in the receivable accounts, then QuickBooks has a nice, easy way to tie out the deposit to the later invoice that we will then create. If, however, we were reporting this in terms of the financial statements, we would need to take this out of the receivable, meaning increase the receivable by that 300 and record a liability for the fact that we have this prepayment and therefore owe something in the future. So be aware of that when you go through this process. This process works really good within QuickBooks to tie everything together, but it's not exactly generally accepted accounting principles. If we were to report under generally accepted accounting principles, under normal accrual accounting, we would have to increase the receivable by this, not have a negative receivable, increase it by 300, and record the related liability for something that we owe in the future.